Welcome back to another exciting episode on the show. You guys know I already bring the best of guests to my show. And once again, today we have a very special guest today. As always, the top 1% of guests. Today's guest is Luis Corrales. Luis, welcome to Hidden Secrets in Books.
Thank you, Dominic. Thank you for having me, and thank you for your audience
All
for
right.
bringing me on.
All right. So I would like you to introduce yourself to my audience.
Sure. Yeah, I'll give you a quick 2 minute background. Luis Corrales. I own a few companies, Corrales Co. It's a wealth management business, and Pine Tree Asset Management, which is a real estate company, real estate development, construction, property management business. Been in the business for almost 20 years. I'm married. I have three children, a fourth one on the way. Originally from Peru, so I'm the product of an immigrant story. Came to the U.S. when I was 10. I'm a father, I'm a son. I have three older siblings who I was raised by. I think I was an accident child. So excited to chat with you a little bit more today.
All right. Thank you so much for that wonderful introduction. So I have some questions here for you, and I would like us to get into them. Okay, so what should every business or what should every entrepreneur do before selling their business?
The big thing that you want to do is you want to have a financial assessment that shows you how much money do you need from the sale of your business so that you could be financially comfortable. A lot of folks approach the sale of a business just thinking about what is the highest price that you can get, which is always a good thing, but they lose sight of what that money actually means to them personally. Folks build a business not just for the sake of building a business, but they do it for some sort of personal objective, whether it's to spend more time with your family, with your kids, whether it's to take some time off, whether it's to pursue maybe another business. So I think it's important for business owners to know how much money do they need in the bank so that they can be financially comfortable for the rest of their lives. And maybe the sale of the business will do so, and or maybe it won't. And that's a big thing. Second thing, and I know you only asked for one thing, is taxes and the amount of taxes that can fall through the cracks if you haven't planned properly for the sale of your company. And I'm happy to talk to you more about that.
All right, thank you so much. So moving on, how early should a founder begin preparing for an exit?
Yeah, look, at least 2 years out, ideally, you want to start thinking about the exit. And one of those big reasons is the comment I made at the end is taxes and tax planning. I get calls oftentimes for business owners that have already hired an investment banker, have sometimes even already gotten an LOI, a letter of intent from a potential buyer. And they come to me and they say, "Hey, Luis, I'm about to sell my company. Please help me figure out how I can pay less capital gains tax." And by that point, unfortunately, it's too late. It's too late when you are already at the 1 yard line. You've signed a term sheet that says your company's worth 30 million. And now we're trying to go back and tell the IRS that for tax purposes, your company's only worth 5 million. It just doesn't work that way. So you need ideally, you got to start thinking things ahead, ideally 2 years early, if not, 12 months early, or if not, spread it out into two different calendar years. Maybe you do some of the tax planning in 2026, late 2026, but then you do the sale in 2027, right? That way, from a reporting standpoint, there's two different tax returns that are issued for two separate tax years.
Okay, Lois, thank you. So moving on, what are some of the biggest financial mistakes business owners make after selling their company?
Yeah, the biggest financial mistake they make is they just don't know how much money they spend on a monthly basis. They get a whole bunch of money, they get a big windfall, they want to do some fun things. Maybe they want to do a celebratory dinner, closing dinner, but then that closing dinner turns into 3, 4, 5, 6 months of idle time if you haven't really thought through what you want to do, which most business owners, quite frankly, haven't because they haven't had much time to think. And as a result of that, they blow through their money. Look, we helped the client in 2021. This is just one specific case. He sold his company for a nice number, close to 60 million. About 37 million of that was cash, and the other 23 million was rollover equity and some earnouts. And good guy, great intentions. But day one, he kind of blew through $10 million in second homes and real estate that's not producing any income and boats and yachts and so forth. So it can, I'm all about, look, enjoying life and celebrating, and you only live once, but you really have to be careful when you've got a big life event, what that actually means and how that may or may not change your lifestyle. So getting that under control, having a good game plan, what it takes for you to run your monthly household is very, very important, particularly when a big windfall comes in.
Okay, thank you. So, how can entrepreneurs legally reduce taxes before and after a liquidity event?
There's a lot of ways that you can do before taxes, after, before the liquidity event, after the liquidity event. There's still ways, but of course they're reduced because you've already gotten paid and that's already been reported from a tax standpoint. On the before side, you could do a lot of things. I mean, look, if you depending on how your company's structured, if you're a C corp, for example, and you have less than 100 shareholders and you've been in business for at least 5 years, an easy win that just got revamped as a result of the one big beautiful tax bill last year is something called qualified small business stock exemption, QSBS. It used to be the first 10 million is exempt from capital gains. Now it's gotten revamped to 15 million. And that's a big number. And a lot of folks don't know that trick. And a lot of folks don't know that you can take that trick and multiply it by 2 or 3 times that $15 million number. Do it legally, do it compliantly, and you do that through something called QSBS stacking, or setting up multiple trusts that own your shares. It's perfectly legal. It is under scrutiny from the IRS because some folks are abusing it and setting up 10, 15 different trusts, which is not kosher. But that's an easy win. And if you can get 15 million and then multiply it by $30 million exempt of capital gains tax, that's a huge win. Multiply that by 23.8% tax rate, and you're looking at $3 to $6 million of tax savings right there. Second idea I'll offer you guys is maybe some of you may already be in the real estate business. I have a lot of business owners. They've made a lot of money in their core businesses that provide some cash flow. And some of them have taken some of that cash flow and they've diversified, yes, into stocks, yes, into bonds, yes, into ETFs and mutual funds, but some have also bought real assets, real estate, whether it's multifamily, whether it's office, whether it's data centers. And real estate has some substantial tax advantages if you are active in the real estate trade. Real estate tax advantages like a depreciation, like a cost segregation study. I've got a whole list of strategies that I share with our clients. Some of them may apply, some of them may not apply, but this is an important part of what we do every day.
Okay, Luis, thank you so much. So, what is the difference between wealth management and true exit planning?
And true, what was the last part you said, Dominic?
True exit planning.
True exit planning. Okay. So wealth management in its most traditional sense, or the way most advisors are trained, is to think about what to do with once the liquidity event has occurred. So most wealth advisors are really wearing just an investment advisor, portfolio manager type hat, but they themselves are oftentimes not entrepreneurs, and again, there's nothing wrong with that model. I came from that model myself when I was at Merrill Lynch, and I spent several years there. I was trained really just as an investment guy, but that's very different training than the real life training that you get being an entrepreneur, being a business owner, having payroll, having to invest in new systems, new technology, new compliance. And ultimately, that I take that insight that I've learned myself over the last 20 years, advising entrepreneurs and being an entrepreneur myself, on how they should be thinking about their exit. Look, at the end of the day, you're not going to take your company to your grave, right? We're all going to exit either voluntarily or involuntarily. So the better path is to do it voluntarily, do it on your own terms. Think about it in advance. Think about, are you going to exit via an internal sale to maybe your management team or maybe your kids? Or are you going to exit via an external sale, to a third party? Whether that's a private equity backed company, whether it's a strategic buyer that might be a bigger version of the company you're selling. And that takes time and that takes some real training. And look, I'm certainly not the only guy out there. There's a lot of qualified exit planning professionals. But the sooner that you can have that conversation and start thinking about which exit path you might want to take, the better. And that's very, very different than traditional wealth management, which just teaches you what to do with the money once it's landed. Many folks can do that. The exit planning is just a different ballgame.
All right, Luis, thank you for breaking down the difference between management, wealth, and true exit planning. So, how do you know when it's the right time to sell a business? You are talking about time to exit, time to exit. What is an indicator of the right time to sell a business?
Look, I mean, I think a big some of it is sort of external events. I think most business owners that have a successful company, they're tracking what their competitors are doing. They're tracking whether their competitors are being acquired or not. So always having a pulse on what's happening in within your specific industry and your specific market is important. And there's a lot of investment bankers that specialize in different industries. So I think having a good dialogue with folks in your specific industry is useful. That's the external side. And then the internal side is a lot about, hey, what fork of the road are you finding yourself in right now? Maybe you've grown the business to a point that it's providing you a great stream of cash flow, and you've grown the business to a point where you've got a good management team. But maybe you've reached a point now that if in order to go from, let's say, 30 million of revenue to 50 million or 60 million of revenue, it's going to require a different set of skill sets, a different set of management team, and ultimately a lot more time for that founder or that business owner to be in the cockpit to take that leap of faith, right? And some founders, what I find usually after 10, 15, or 20 years of building and nurturing their baby, they might just be ready to move on to something else, right? And so that's the internal factor that a lot of times motivates folks. They feel that they've just put too much time into building and nurturing something, and they want to do something different with their lives. And then sort of that takes a little bit of deeper thought, that takes a little bit more introspection. But if you can couple that with maybe a healthy market of what might be happening on the external side, if you find out that maybe some of your peer companies are selling for attractive multiples, then you might as well strike while the iron's hot, and start a process, talk to multiple buyers, see if you can get a controlled auction going to bid up the price, and do some of the tax planning in parallel to that to really reduce your tax exposure as much as possible.
Okay. Why do so many successful entrepreneurs end up paying more taxes than necessary?
Yeah, look, it's just a lack of planning. If you pay more in taxes than you want to, a lot of it might just be you just haven't planned things out in advance, or you may have outgrown the current set of professionals that you're working on, or that you're working with. I see that all the time. I see folks that I meet that they might have their best friend who's their investment advisor, and they have somebody else, Jack Smith, who's their sort of CPA for 20 years. But those folks may be good when you first got started, but they may not be the right team that you need as you've scaled, right? I mean, that happens in every relationship. Some relationships you can grow with over time, and then others you've run their course and it might be time to move on. There's nothing wrong with that. It's just a natural part of life. And that's what a lot of times I see, or a lot of times what I see is that business owners are just so busy in, sort of in the nitty gritty, doing what they need to do, bringing in the revenue, managing the team, hiring the people, finding new products and new services to bring to market. And they don't take a whole lot of time to think about that silent partner that we all have that takes 35 to 40% of our net income, and it doesn't have to be that way. Most of our very successful family office, ultra high net worth clients, we've created a team for them. We've created a multifamily office for them that allows them to just delegate these things. And we turn every single stone from an IRS tax code and do it legally and compliantly. And we look at every single investment strategy that could potentially be beneficial to this client, so that again we can create presumably attractive returns, but then also do it in a very tax efficient way. And that just takes time, it takes knowledge, it takes having the right team, and it takes just a little bit more skills to put it all together.
Okay. So how can business owners turn a successful exit into generational wealth?
That's a very tough one. Look, out of all the exit paths that a business owner can take, the one that certainly most founders would like is the intergenerational path. Not realizing though that that's the one that oftentimes is the hardest one to execute. It's tough. Look, it's tough. You created the baby, you've nurtured the baby, you know every single aspect of the business, and unfortunately, the reality is that a lot of business owners are so tied up in their day-to-days thinking about the business that and the kids may have seen that. They've seen how hard the parents have worked. And at some point, unfortunately, maybe less time that folks have been able to spend with their children. And sometimes some children resent the idea of getting into the business, because they just don't want that type of lifestyle. They don't want to feel like, the buck sort of stops with them. And so for our business owner clients that are thinking about that, we always encourage them to, to the extent possible, get your kids involved in the business early, particularly if that's a path that you want to explore. It doesn't mean that that has to be the only path, but if you want to have that as an option, get them exposed, bring them to meetings, talk to them about what you might be talking to a particular client about, we do that ourselves with my wife, who's my business partner on the real estate side. We bring our kids to the job sites. I have them listening in on meetings just so that they're tracking and they're aware. And I actually ask him, hey, what did you pick up from the meeting, right? So the earlier you can get your kids thinking about business type stuff, the more likely the succession planning strategy to your children from an intergenerational standpoint is going to work. If you're expecting that your kids are just going to want to inherit the business, which I don't think that they should, I think everybody has to earn it. That it's tough, and it's tough. You're kind of setting up yourself for failure. I've seen it over and over again with business owners. There's a study out there that says, the first generation builds it, the second generation sort of maintains it, and unfortunately, the third one ruins it, right? But it doesn't have to be that way. It doesn't have to be that way. And I think we all need to talk to kids, and there's a true financial literacy and business literacy gap that exists in our current education system. And I talk about that with our clients all the time, right? Get your kids involved, talk to them about what it is to be a business owner and the responsibility that it takes to hire people and make payroll, and how you talk to them about different performance reviews. And it's sort of interesting. Look, my oldest is only 6, and I talk to him about these things, and I don't know if he's fully capturing everything, but at least he's getting that exposure, right? So that's one of the things that we encourage our clients.
All right. Thank you so much, Luis. So, talking about real estate, what role should real estate play in a long-term wealth strategy?
Yeah, I think look, to I think it can be a very attractive sort of asset allocation and diversification strategy for clients. I think that the one of the biggest downsides of real estate is that it's not liquid. At least if unless you're sort of buying it as a function of like a REIT, right, which is a publicly traded instrument that you can sell in the exchange. So to the extent that you've got a dollar, and we encourage clients to always diversify that dollar and put it into different buckets that do different things, because there's never any one tool that is sort of like the magic bullet that does it each and every year, right? So I think real estate can play a great piece in somebody's puzzle, but I'm always very hesitant or cognizant on sizing, which means what percentage of someone's total asset should be allocated to any one asset class, right? And when you add the illiquidity factor of real estate, then that's an even more important factor, right? So generally speaking, when it comes to real estate and real estate as an asset allocation tool, we're looking at anywhere between 5 to maybe max 20 to 25%, depending on a client's time horizon and risk tolerance and overall investment objectives. But I do think that most people like the idea that it's a tangible asset, that there's underlying dirt or land that generally doesn't lose value. There's also a structure, of an actual property that, is used to house, whether it's families, which is apartments or multifamily, or office tenants, which is business owners or data centers, or some folks like the self-storage idea because, you're just sort of renting out little spaces and for people to put their stuff. So I think it can be a hugely beneficial tool. I think it's got some very attractive tax benefits, particularly if folks get more and more involved in real estate and they're active real estate investors per the IRS rules. And I think it complements, a total portfolio quite well as well, stock and bond, mutual fund, ETF portfolio. So I think it's often overlooked. I think a lot of folks don't understand it. But again, part of what we do is take the time, walk through what it means, what the pluses and downsides are of each and every single tool, including real estate. And then we kind of make an assessment of what role it can play in a client's particular asset allocation strategy.
All right. Thank you so much, Luis. So, thank you for sharing your story and your journey and your insights about building, protecting, and preserving wealth beyond a successful business exit. So, for those who would like to connect with you and learn more about your work, how can they do that?
Yeah, you can connect with me via LinkedIn, Luis Corrales. I'm the founder of Corrales and Co. and Pine Tree Asset Management. You can also send me an email, lcorrales@corralesco.com. Yeah, for anybody that's interested, I mean, look, I'm all about giving back. I don't know everything. I'm also all about learning and learning from the experiences of others. So definitely would welcome the opportunity to connect with anybody that has additional insights.
All right. Thank you so much, Luis. Thank you, and do have a wonderful day ahead.
Thank you, Dominic. Appreciate you having me on.